get into some levels and data. All right, good morning, trade pros. Welcome to morning market update for this Monday, or not Monday. It is actually Tuesday, May the 5th of 2020. It's George from TRADEPRO Academy. Hope you guys have had a great day and evening, or wherever you might be, whatever your time zone is. Markets had advanced overnight. We'll talk about a little bit of what's driving the upside. We got a great update for you today. First and foremost, for our Mexican familia and family friends and everyone across the world and subscribers, listeners, and our family, I want to wish you a happy Cinco de Mayo. It is a holiday for you guys. All these holidays are tied to some kind of war act, but it's a big day for you. So celebrate it. I know that this quarantine kind of doesn't allow you to do much, but you could still celebrate. You can be trapped physically, but not emotionally. No one can trap you emotionally. All right. Overnight, senior Trump administration aides have said that the relationship between U.S.-China, which has soured a lot, especially on the trade deal and expectations, a lot of U.S. officials are saying there's not going to be any economic punishment for China as long as it sticks to the trade agreement made in January. All right, China's criticized a lot of top officials in the U.S., but not Trump directly. And so it's interesting. Some articles are saying China's gearing up for or preparing, not for the offensive or the defensive play, but just nothing in specific. So they're preparing for a possible armed conflict with the United States. You don't want to see that. That's not good. Even those words alone being uttered are very bad. So there's just that. It's an article that I was reading. Okay, I read a lot of stuff, so I can give you an unbiased full angle, and you need to know things outside of what just traditional media prints, because traditional media, don't tell anyone, has a motive, and it doesn't really serve the investor. And so that's the only reason we don't really listen to it. All right. U.S. researchers and officials have warned about the possibility of a new coronavirus outbreak, a second wave. This is interesting because a lot of states and countries are starting to reopen their economies and relax the social distancing rules a little bit, at least trying to get back into a normal life. We know we're not going to be locked down forever. And, I find this comparable, or when things like this happen, you got to use the past as a reference point. And we do have a reference point, and this was the 1918 Spanish flu, which had, it's the most recent, really, really, really violent outbreak, which is way worse than what the coronavirus is. The coronavirus is what people in the Spanish flu would have wished they had. All right, it was bad. So the Spanish flu came in 3 waves. This was interesting. The first wave was the smallest. All right, the second wave was 5 times more deadly in magnitude than the first wave, and it came 5 months after the initial one. So look, coronavirus is not the Spanish flu, but if you were to kind of superimpose that and take 5 months on top of March, you get August or towards the end of the summers when a second wave could hit. And then there was even a third wave with the Spanish flu, which came 4 months after, and it was half the rate of deaths that were occurring. So there was a small blip, one 5 times bigger, and then one that's half of that, or almost double the initial one, 2.5 times actually, if you do the math. So it's interesting to have that curve. So here's what the question becomes: New York State's expected to start reopening businesses May 15th. All right. In the first phase, they're going to do construction and manufacturing in certain regions. They'll resume operations. Select retail stores as well will be opening in mid-May. All right. And there's going to be a lot of new information that surfaces towards the end of May. Then we'll find out what the situation's like with this reopening, because cases they lag. All right, what you're seeing in cases today is because of people infected a week or 2 weeks ago, up to 2 weeks ago. So end of May becomes a really crucial point for the markets and for this whole ordeal. All right, so keep an eye on that. I don't think we're out of the woods yet, but I also think that the lockdown scenarios have far exceeded at this point, all right, what they should have. And so I know that that's a controversial statement, and I have data to support my opinion. It's just an opinion, okay? But here's why I'm talking about this and how it's going to impact markets. We've put on a lot of debt as a global society to battle this pandemic, if you will. Get this. The war on coronavirus is what I titled this little segment, okay? World War II had 75 million casualties because, and I use the war term because we have declared war on coronavirus. So we had 75 million casualties in World War II, and the GDP as the spending as a percentage of GDP, which is what a country produces in 1 year, was 41%. So we spent 41% of a whole year's production to combat and to prepare, to get out of World War II with 75 million casualties. All right, get this. What percentage of GDP have we spent to respond to the coronavirus pandemic? Pop quiz. I want to see it in there. This is, to me, it wasn't surprising, but it was nice to actually know the number because now you have a comparable. And in the meanwhile, I'm going to get you the latest global deaths. All right, I got them. So what percentage of GDP do you think was spent? 280, 10,000%, 75, 12%. It's interesting because with all these numbers coming in, 78, 200, if you would have asked me, I would have had an arbitrary one too. So I have an unfair advantage. So I'm not saying you guys, hey, you're wrong, but there's so many wide spectrum of guesses, which points to the fact that we don't really know. This isn't information that's being shared. You have to dig to find this kind of information. All right, 35%. So we're 6% less spending on a virus that, on a pandemic virus versus a war. This is as a percentage of GDP. So it's not dollars, so you can't say, oh, that was back then. So a dollar ain't what it used to be. Okay, so how many people has the pandemic caused casualties to? $253,000. So if you really divide the response money per person, you get a number that's astronomical in comparison to something huge like the World War. All right. The 2009 financial crisis was 24% of GDP. So we've exceeded the 2009 financial crisis stimulus response by 50% more. So here's what I'm here to tell you. You're going to say, holy smokes, we're spending all this money on the coronavirus situation. The government cares about the people. Here, I'm going to tell you something that not many people will tell you. It ain't about the people. It's about the economy. All right. This entire response is an economic response more so than it is a pandemic response. Just look at where the money is going. All right. It's not about the people. This is about business. This is about the economy. That's what that's who the Fed works for. The Fed's boss isn't you and I. All right. The Fed's boss is the economy, but it's funded by you and I. Actually, not by I. I'm Canadian. I don't fund a single penny of the Fed. Right. So here's the situation. The Fed stimulus program, as drastic as it seemed, was designed to avert a crisis. This is going to blow your mind. All right. JP Morgan has $46 trillion of exposure of derivatives of financial assets. Yeah, I said the T word. All right. Get this. What default percentage would need to happen in JP Morgan to wipe out the entire bank's capital? All of it. 100%, zero. They'll be left with nothing. What default rate is necessary on the entire loan book of JP Morgan to cause a default? You're going to understand how fragile this economy really is when you drop this number. Angela, where'd you get that guess from? Just curious. 8%. Let me see some of the trade pros in the room. 3, 2, 8, less than 4. Under 1. 15%. Craig, 10. All right. The answer is 10. If 1 in 10 people default on their loans, JP Morgan is worth 0. Right? Why is that mind-numbing? Because 100% of people are quarantined at the moment. Right? So you got to understand that when the Fed took this big action, because the consequence is disaster. Without the Federal Reserve, I guarantee you 1 in 10 people would default throughout this pandemic. We locked everybody down, all right? And the Fed did absolutely nothing. More than 1 in 10 people would default. We'd have another banking crisis. And so this is why the response has been so drastic. All right, I want to give you this piece to get you guys thinking again, because a lot of you are wondering, hey, what's happening? What's going on? How come the market's doing this? The market's reacting to what's going on behind the scenes. Behind the scenes is this. A lot of money's been printed. That's circulating its way through. The coronavirus is more or less contained. I saw somebody say flattening the curve. The curve's been flattened, but hospitals haven't really seen as much intake as they expected. All right. So the fact is, We flattened the curve, but we've also flattened the curve on the economy quite a bit. All right, we flattened a lot of curves with the response. It's been a drastic response. Time will tell whether we did the right thing. And in hindsight, everyone could say, hey, it was a good time to buy over here because it was a low. But what about right now? And in the real time, it's harder to make decisions. So what I'm watching for this market, I don't think we're out of the woods yet, but I think what's going to happen after some of these restrictions are lifted is going to be the big deciding factor. Restrictions get lifted, there isn't a second wave or it's less drastic, and the economy starts chugging along, everyone goes back to work. It'll be a slow recovery. It'll take years. I think it'll take 4 or 5 years for the economy to recover. The market might hit new all-time highs in a year and a half, but the economy will take a long time to recover. Consumer sentiment will take a long time to recover from this. Okay. But if that happens, then great. That's the optimistic scenario. If we reopen this economy and everyone goes and spreads the disease, and then now, it gets even worse, more people die, another more severe lockdown comes into play, market's dropping 50% at least. Okay. It's going to be a big problem. So I think the next 4 to 6 weeks shapes kind of the whole narrative of this coronavirus situation. Be very careful because it's getting complacent again. All right. Citigroup says, let's move on to markets today because I didn't mean to make this piece this long, but I want to talk to you about it because it's a serious concern. Citigroup is saying that based on their commodity trading advisors model, 2867 looks like a good short squeeze level. We're trading it right now. There could be some buy stops above. I think target today is like 2895s on the ES futures. And so I'll be looking for a little bit of upside after a pullback. All right. Overnight, China's still closed. They have a Labor Day that lasts 4 days. Their holidays from May 1st to May 5th. So it should be called Labor Days holiday. Hong Kong's up 1.1. Japan is also closed at midday in Europe. London's up 1.2. Paris is up 1.5. Frankfurt's up 1.5. And in the U.S., Dow, S&P, and NASDAQ up about a percentage point. If you're wondering why gold is so quiet, it's because China's closed. China's a really big merchant, consumer, and trader of gold. And it's not the only reason, but it's a big part of the reason. Crude oil's up 10%. We're starting to see a little bit of production cuts, and as this reopening and loosening of restrictions happens, it's going to create a little bit more demand for transportation, and car and truck fuel demands are 40% of entire oil demand. So that's important. So some demand's coming back online, even though it might be temporary. We don't know. And crude oil's feeling a little bit love, up 10%. Bitcoin's up 2.4, and in today's economic reports, 10 a.m. we have ISM non-manufacturing, 2 p.m. Fed's Bullard and Bostic is speaking, so not much. Keep an eye out on your levels and your order flow. Let's ride this thing out. I'm sorry, I don't really got too much time for questions. Just let me see. Yeah, we'll take some more of them tomorrow when this isn't super dense. I love you guys. I hope you've enjoyed it. I try to look at both sides of the picture. When everyone is super optimistic, I try to find evidence on the other side. When everyone's fearful, I try to find evidence of opportunity. And by taking the reverse side, you learn a lot more than just going with the official narrative. All right. Who said this? Damn it. I think it's Mark Twain. He said it's a lot easier to deceive people than convince them that they're deceived. All right. Careful what information you read and how you interpret it. It's very important for your investing. Doesn't matter about your life because I'm not here to give you life guidance. I'm here to give you investing support. Careful what assumptions you make. They dictate how your portfolio performs. I love you guys. Have a great rest of your day. See a bit of a short squeeze coming after a morning pullback. Let's get on board and trade this thing. Let's send it over to our oil desk in Atlanta. And we're going to come back to equities afterwards. You guys have a great day on YouTube. Going to end the stream. Love you all. Be careful. Manage your risk. Trade Pro. Peace out. Morning, Boxy. How are you?